the number one question I ask, which usually floors people, is what do you need today to build your business? And people are like, well, nobody asks me that. Everybody wants to know, they want to tell me all about themselves and about their business. But if you can tell me, you need a new accountant, or you need a contractor or a painter, I'd say, I can hook you up with this person. I can hook you up with that person. Now, I've just added value to your network because I'm helping you build your business.
My name is Maria Mendoza, the guest host of Why Real Estate Podcast, and I would like to welcome you to our platform for today's investor interview. Today we have the founder of BHB Group, LLC, Bel-Air Property Management, LLC, and for 18 years, the prior president of Northern West County Landlord Association, Ryan Lucier. Thank you, Ryan, for being on our show today.
It's my pleasure to be here, Maria. Thank you so much for hosting the podcast today. It's a little different. I'm usually in your seat doing the interview, so it's a pleasure and honor for me today to have you as my co-host to interview us. So thank you very much for the opportunity to be on your podcast today, Maria.
Perfect. So let's start. So can you please tell us a little bit about your background and what you used to do before getting into real estate?
Yes. Long before, in my previous life, I was a graphic designer and illustrator. So I used to work for some really great accounts. I would have IBM, Adobe, Microsoft, and it was really interesting because I was a contractor to other agencies. So they would hire me as a third-party vendor to do work. So I never had to go out to pitch to Adobe or pitch to IBM or pitch to Microsoft. Those accounts were coming to me because of the relationships I made with other advertising agencies. So I became a supplier to the industry. And it was later in my career when I worked at the agency at Fidelity Investments. I worked with a really great team of creative designers doing websites and different types of collateral material, spectrum performer brochures, 401ks. And I'll never forget that infamous day eating my tuna fish sandwich at lunch. Everybody else went out for lunch, but I was frugal and I brought my own lunch and I was eating it, and I decided to start reading the spectrum performer that I was working on, and I did the numbers, did the math, and if I followed the advice that we were giving to other people, I could put a certain amount of my income into a 401k, and if it hit the performance that we were saying it could hit, later, when I retired, I could withdraw off of that and live off of that income. So that sounded really enticing and interesting. So I started to pencil out the numbers and figure it all out. And if I drank that Kool-Aid and followed that plan, I would have had to go back to work at the age 75 because I would have run out of money. So I said, no, this is not the best plan. So that year when we were doing our taxes, and I got a shout out to my wife. Today is our 26th wedding anniversary. Happy anniversary, Hanju. 26 years. Love you very much. Could not have done this without you. So thank you. But we were sitting down with my accountant. I was a vendor contractor and she was a full-time employee. So she was seeing the benefits of owning a business, taxes, and what we could do and what we could deduct, and the income and expense, how that would all work. So just out of the blue, I asked my accountant, what would it look like for us if we purchased a multifamily property? And I didn't know it, but my accountant was a landlord. So he pulled up a depreciation scale, started to show us all these different variables and numbers, how over time the value of the property would stay the same, the mortgage, or the value would go up, the mortgage would stay the same, and that spread of equity would grow. And he explained the tax ramifications and the savings and all these other things. So that became really interesting. Another factor was my father. Growing up, he was a contractor and a builder. And I think you're going to get to this question, but I'm going to jump ahead a little bit. And there were 7 kids in our family, and he would build houses. So he would buy a lot of land, build a house on it, sell the property, and then do it again. And that's how we put food on the table to feed a family of 9. It was later in my dad's career that he built an apartment building with 8 units in it. And long story here, but he was the first builder in Leominster to have the zoning for a condominium. So his 8 units were actually zoned condominium, and if he ever chose to, he could sell them off separately. But he kept them together as a multifamily unit, and I saw what that was able to do for my mom and dad. They were able to live in one of the units and collect all this rent-free. Because my dad built the property, his cost of entry was really low. I think way back then he built all 8 units for maybe $30,000-$40,000. That property today is well worth over $1.5 million. So yeah, you can't see ahead in time what real estate's going to do, but you can always look backwards to see what other people have done and say, wow, that sounds like they were really smart or they had the Midas touch. But it's just long-term staying in the game and just staying consistent and solid day after day. So that was a long answer to what did I used to do before I got into real estate. The short answer was marketing and advertising, and that led into becoming a property investor.
Right. So well, you kind of already answered my next question, but still maybe there's something else that influences that either when you were growing up or people, not counting your father, like someone else that could affect you in the interest of real estate.
Absolutely. And I'm glad you went back to this question because there's more people I'd like to give props to, acknowledge their influence on my life. When I was working at Fidelity Investments, there were 2 other real estate investors there. And Hanju and I, we had already bought our first property, maybe our first 2 or 3 properties. And Tom Payne, really great designer, and Gene, another really great designer. Gene had a single family house, I believe, down in Plymouth or Quincy, and Tom was buying duplexes in Plymouth, Massachusetts. It's a different market, all different markets. We were all buying in different markets, but we would compare notes during lunch or when we take a break. How's it going for your property? How's it going for your property? So it was good to have a group of other investors that we could bounce ideas off of. So that was really important to have that support. They say you are an average of the 5 people you hang around with. Yeah. So it was really good to have a couple other people doing real estate. And I didn't know it, but Hanju and I got married, but her parents and her grandparents were real estate investors in South Korea. They were buying, her grandparents were buying farmland in Seoul, Korea before it was Seoul, Korea. So they had the vision to see real estate and what it could be and what it can turn into. And they actually had property in Gangnam before Gangnam was this hip cultural place. So my wife grew up seeing investing going on, seeing her grandparents and parents investing in real estate. So when we teamed up as a couple, I had the construction background and some of the street smart experience, where she had a lot more of the commercial background, commercial properties and development. And she brought a lot more financial stability. She brought a different perspective. So it's always good to have opposites on a team. Somebody does one part really well, somebody does the other part really well. So my wife was actually a great influence to me, and some of my teammates working at Fidelity who are also real estate investors. And then later in our career, as we were buying properties, it happens. Eventually, you're going to have your first eviction. So we had our first eviction at one of our properties. And after that, we were contacted by a landlord association, the Northern Worcester County Landlord Association. Never heard of them, but they were scanning the summary process list of landlords who had to go to housing court. And they reached out to us to ask if we'd like to get involved with the association. And we'd never heard of any type of landlord association or training type of institution or something like that was out there to help landlords. We were operating like the Lone Ranger. We were trying to make up and figure it out as we went. So we went to this meeting and we were blown away that we were sitting in a room with like 100 different landlords. Just the experience in that room, if everyone had 10 years experience, there was 1,000 years of real estate investing experience in that room. And we were starstruck. It's like, oh, goodness. We were humbled. We walked in. I remembered we met our first property manager, and she introduced herself and said, yeah, we manage 100 units. And my wife and I, our jaws dropped. I think we had maybe 10 units at the time. It's like, oh my goodness. We found people that we could really learn from. So yeah, networking and seeking out those relationships that really helped us to grow and build our network, to learn more. So yeah, a long answer to that one, huh?
Yeah. And the big question that I guess everyone is wondering is why real estate?
Why real estate? Isn't that the multi-million dollar question?
Exactly.
Well, in my opinion, as a real estate investor, I think multifamily real estate investing is the best asset class of all real estate property investing and other investing devices as well. I think real estate outperforms the stock market, 401ks, bonds, mutual funds, any other type of investing, because those types of investing, you have to put 100% of your money into it. And then the returns you get are the returns you get. Only in real estate can you leverage the money from a financial institution like a bank. So if I was going to buy a $100,000 property, I could put in $20,000 to $25,000 of my money, 25% down, and leverage 70 to 75% from the bank as a mortgage and get to control 100% of the entire asset. So looking at leverage, if I had $100,000, I could buy one property cash and control one property. Well, with real estate, I could buy 4 different properties, 25%, 25%, 25%, and borrow the other 75%. And for my $100,000, control $400,000 worth of real estate. And the story just gets better from there. So as far as multifamily or industrial or commercial or retail or office space or storage, for me, people always need a place to live. So rental property, rental investment, residential, commercial has always been my focus as an investor. And what happens over time, the rents are going to go up, the property value is going to go up, but your mortgage is going to stay the same. So your equity spread is always going to grow in multifamily real estate. Now, the market may go up and go down, but your mortgage is going to stay the same. And over time, every 10 years, every 10 years, we've seen rents double. And in this past market, we've seen rents even explode beyond that. So for me, why real estate? Multifamily all day long, for me, I feel is the number one real estate asset class.
Okay, perfect. So, also time of for the big money question. What is the best piece of real estate investing advice you could give to someone that is starting out?
Wow. Get started. I meet so many people. We've been to so many webinars, seminars, boot camps, training, and there'll be 500 people in the room. And of that 500 people, maybe only 5% will get out there and take action and get started and start doing it and do the hard work. And it's hard work. You have to make the connections. So the number one piece of advice I would say is just get started. You're not going to have it perfect when you get started, but real estate is forgiving enough. It's like a train on a track. So you can see it coming, you can see the market moving, and you have time to get on the train or get off the train or step onto the track or step off the track. But definitely get on the train because it's going to be moving and you can always correct along the way. So absolutely get started. You have to pick a market. The other thing, the biggest mistake I see new investors make is they're interested in wholesaling or foreclosures or short sales or multifamily, and they never pick one target and know everything they can about that one target. You have to be an expert in one market. And if you can do that, just get started. For me, it was multifamily, and just keep learning, keep educating, keep building your network. But just get off the couch, shut off the TV, hide the remote, get started, open a book, educate yourself, constantly keep educating yourself. That would be the advice I would give to myself 25 years ago and to anyone starting today. Just do it. Get started. Yeah, absolutely.
So, talking about education, what book in your investing career has had the biggest impact on you?
This is such an ironic question because you are sitting in my chair. Anyone who sees this video, they can look behind you and see the complete library. Well, not complete. I keep adding to it all the time. But I would say the biggest book that changed how I think about investing, and I've heard so many other investors say the same thing. Robert Kiyosaki, Rich Dad, Poor Dad. That book changes the way you think about assets and liabilities. Like in America, the American dream is to own your own home, your primary residence where you live, and that is considered by general public to be your largest asset. Well, Robert Kiyosaki explains an asset puts money into your pocket and a liability takes money out of your pocket. So that totally changes how you look at your primary residence. Because if I live in a house and I'm paying the bank calls it an asset because they're getting paid. For me, it's a liability because I'm paying for it. Like a car is not an asset. I constantly pay for it. A vacation is not an asset. That's money come and gone. So if you're buying an asset that puts money in your pocket, that totally changes how you look at investing. So yeah, Rich Dad, Poor Dad. I've heard so many people just say that that book has been a game changer in their investing career and how they think about investing their money and buying assets or liabilities.
And is there a second book?
Funny that you would ask, because there's absolutely a second book. And I think I can see it on the bookshelf behind you. This book, I think it's on the other side, right over there. But yeah, probably under the picture of the pelican. But
Okay.
I believe it's Michael Gerber, The E-Myth Demystified. And what he does in this book, he tutors this woman throughout the book. Her business is all about pies. That's the name of her company. And of course, she bakes pies. And she was never able to duplicate her process. So she could only bake so many pies a day, only sell so many pies a day. So the E-Myth Demystified breaks down the 4 different classifications. You've got your worker, your business, like a plumber, someone who works and owns their own business, and then somebody who owns the business and develops a system. And the E-Myth Demystified forces you to look at your business as a system, like an operations manual, a franchise prototype, like McDonald's.
Yeah.
Any McDonald's you go to, they're going to serve that same cheeseburger with half a slice of cheese down the middle, 1.5 pickles, and a little squirt of ketchup and mustard, always the same. So every single franchise you go to, they have an operations manual, always build things the same way. And I know in our business, we've worked together, you, your sister, and I. And even this morning before this call, we had an operations meeting to look at what we were doing, how to do things better, and to document that. So it's always a process. So the book E-Myth forces you to look at your business and stop running it like a hobby and really pay attention and start running it like a business. Yeah, so those 2 books were really critical. And I'm going to throw in a third book. This is also Robert Kiyosaki. It's Cash Quadrant, and it explains the 4 different ways that you can earn income. One is as an employee, you have a job. And then the other would be an employer. Again, if I were a plumber and I own my own business, then I call the shots and I work for myself. And then the third would be running it like a business, being a business owner, hiring employees, and leveraging time of several employees to get more work done. And then the 4th quadrant is an entrepreneur, where you're investing in assets or in businesses, or you're a general venture, a JV investor in somebody else's business. So yeah, that one book is all 3. Robert Kiyosaki, Rich Dad, Poor Dad, Robert Kiyosaki, The Cash Flow Quadrant, and Gerber's E-Myth Demystified.
Okay, so getting back to your experience, what was the best deal you ever did?
Wow. Well, there's 2 that come to mind. So I'm going to tell you the short one, and then I'm going to tell you the long one.
Okay.
So how much time have we got? I'll just keep going.
Yeah.
So the most lucrative deal we did is we bought a foreclosure. This was a vacant building that nobody lived in and needed work, and it was a 4-unit property. It was probably valued at $280,000, but nobody wanted it. And this was in 2008 when the real estate market tanked. So we went in and made a lowball offer for $40,000. So we bought this $180,000 asset for $40,000. We paid cash. So we had equity of $140,000 in this property. So we went to a bank that we had been working with, and we refinanced that property. And that's a technique you can do in real estate that you can't do in any other asset. Because we had equity in the property, we could go to a bank.
Sorry, I didn't understand that.
Thank you. Thank you so much. It's my watch telling me I have to do something. So we were able to leverage the equity in that, and it's called a refi cash out. So we own the asset. We had $140,000 of equity into it. So the bank would allow us to keep our $40,000 as the down payment and suck out cash $140,000. Now, when you do a refi, that's not income. You do not pay taxes on that. So that was a wonderful deal. Later, we sold that property for $250,000. So if you took the 140 plus the 40, 180 out of it. So we had a return of over 200% on that one deal.
Wow.
We never touched the property. We never rehabbed it. We never did any repairs. We just let it sit there empty as an asset because of the value it had and leveraged the equity on that to get cash out of it. So we sold that property, walked away, paid a little bit of taxes on it, but we leveraged all that cash out of it. So the other deal that we did, and I'm going to say right off the bat, do not do this. It was very risky. It was very dangerous. And I don't think I'd ever do it again.
Okay.
There. Now everyone's listening and wants to know, right? So we bought the first commercial property we ever bought. This was a long, long, long time ago, but we were buying residential. So in lender terms, 4 units and under is residential. And then 5 units and up is a commercial loan. So we'd never had to do a commercial loan before. And this was the first property we ever did a commercial loan. So it was a 7-unit property. It had 6 residential and 1 commercial. You may recognize this property, 14 Marquette Street. You know this property. We're actually renting it right now. So yeah, this property, when we bought it, we had my wife's credit card and we had my credit card, and we leveraged $50,000 and $50,000. So we borrowed $100,000 off of our credit card to purchase the property as the down payment. Do not do that. It's very dangerous. It's a risky strategy, and this whole deal could have blew up on us. So we took $100,000. We had the down payment at about $30,000, $40,000 worth of renovations, and we took this 6-unit property, and within 6 months, we renovated it, got it rented, and were able to refinance it. We had built up enough. We built enough value add. We created equity and appreciation because of the renovations we did, that the value of the property actually went up higher than what we purchased it for. So we were able to refinance it with stabilized new tenants, 1-year leases, and we were able to take out $130,000 on the refi, tax-free. So we were able to, within 6 months, it was 1-year interest-free on the credit cards. We were able to pay off the credit cards,
Yeah.
which would have kicked in at 18%, which was outrageous. And we were able to put $30,000 in our pocket. So net, we got this property leveraging the down payment, leveraging the mortgage, getting a refi, and putting $30,000 in our pocket. So from an outsider's perspective, we got paid $30,000 to take this property for free.
Yeah. Very risky, but it worked for you. So
Very risky. And now, 10, 15 years later, it's valued at almost $1 million.
wow.
So, I mean, the equity just keep going up. We've refinanced it maybe 2 or 3 times and sucked out over $500,000 tax-free. So for us, that was a great property. And anyone, if you're afraid of going larger, I would definitely do a 6, 8, 10, 12, 16 unit property if you could pull it down, because the numbers for residential real estate commercial rental, I just don't see any other investment that could have done that for us. Yeah, we took a big chance leveraging out those credit cards, but the payoff has been tremendous, and we still owe the property today.
And how do you find these 2 properties?
Relationships, all the time. I tell people that real estate is a relationship business. So you build relationship with realtors. On the residential side, they're called realtors. And on the commercial side, a realtor is called a broker. So building broker relationships and growing realtor relationships, getting out there to the networking events. There are RIAs, that's a Real Estate Investor Association, Landlord Association, different associations who invest in real estate. You're just going to meet people and build a network of people. This person might know of a property that they're not interested in, but they're talking to you, and that's a fit for you. So they'll put you in touch with that. And being able to perform, and when you say to a broker or a realtor, you can perform, what that means, what they hear is you're going to come to the table, you're going to make an offer, you're going to do diligence, and you're going to close on that deal. That's performance. So what they hear is that you're someone who's going to perform. And if a realtor or broker knows your company or your business is someone who can perform, they're going to give you those deals. So back in 2008, we had a relationship with a realtor, and she was just throwing us deals, deal after deal after deal. And we could also build realtor relationships on the MLS. And the MLS is all automated now. So say you're a realtor and you have listings in a certain market. If I told you I was looking for a specific type of property, you could directly send, nothing you would have to do, it'd all be automated. Emails would show up in my email box every day of the type of properties that you have for sale that I would be interested in buying. So it's all automated. You could just know my criteria. You're the realtor, so you have access to the MLS, which is the multi-listing service. And you could just have deals coming to me over and over. So there came a point when my wife was very, very active. She would get listings in the morning. I would get listings in the morning. And then we'd go through, we'd analyze them quickly to see if they were within our criteria that we wanted to buy. Then we'd get together for breakfast, have a coffee, and say, okay, I like this one, this one, this one, and on your list, I like that one and that one. And then we call the broker, say, hey, put in an offer. We want to see the property. We can drive out today. Give us the lockbox code. And we would just be putting in offers one after another. And it's all through the relationships. If you do what you're going to say you're going to do, you're easy to work with, and people like you, and you're not a pain in the butt, they're going to want to work with you. They're going to be happy to do business with you. And if they've got two different people looking for a property, and they know that you're going to buy that property, be easy to work with, not retrade the deal, not be a pain in the butt, and they don't know what it's going to be like to work with this other people, they're going to throw you the deal. So yeah, it's building relationships, building networks, being accountable, having integrity, doing what you say you're going to do. And you got to add value first. So you don't try to build a relationship. What can I do, or what can you do for me? When I network with people, the number one question I ask, which usually floors people, is what do you need today to build your business? And people are like, well, nobody asks me that. Everybody wants to know, they want to tell me all about themselves and about their business. But if you can tell me, you need a new accountant, or you need a contractor or a painter, I'd say, I can hook you up with this person. I can hook you up with that person. Now, I've just added value to your network because I'm helping you build your business. So later down the road, when you know what my business is, you're going to think, oh, well, Brian and Hanju, they helped me build my business. I've got this opportunity to give it to them.
Yeah. And what was the biggest hurdle you had to overcome as an investor?
Money. Absolutely. Absolutely. And everybody starts in the same boat. Everyone thinks that you have to have a lot of money to get started in real estate. What you need is intelligence, education, and a deal that works. Because if I can present to you an opportunity that works, and you have the opportunity to invest in the deal, you write a check to get a bigger one back, then you as an investor, as a passive investor coming into a deal, I don't need the money. I need to present the opportunity. So if I can find the opportunity, find the market, find the property through my network with the brokers and the realtors, bring that opportunity to the table, then it's easier for me to attract a passive investor who doesn't necessarily want to go to the property and deal with the contractors. They just want to write a check, get it back. So money was the biggest hurdle. But after you build credibility and momentum, it's not so much as an issue anymore. Because when you have that first investor that invests in your deal, they're going to tell their friends, hey, I invested with BHB Group and I got a great return. And they're going to say, do you think you could introduce me? So back in our early careers, for 2 years in a row, Hanju and myself, we purchased over $1 million worth of real estate in 2 years in a row using 0% of our own money, because we were able to bring in an investor as a promissory note. That's where I guarantee them a certain return. We were giving our investors 10%. So every month, because the deal would work, we were able to pay them 10% interest for a 2 to 3 year term, and then just pay off the full amount. It's called a balloon payment. So we would make interest-only payments for 2 to 3 years on a property that we knew we could go in, rehab, force appreciation, refinance, take that money and pay back the investor. So money was absolutely the biggest challenge.
Interesting. And what is the next for you?
What is the next? Well, COVID happened on the planet Earth and changed the way everybody did business. So it forced us at our rental management company, which is Bel Air Property Management. We couldn't go into the office anymore, and we had to rethink on how we ran our business.
Yeah.
We had to develop procedures and processes and a different way to do things without interacting directly with people. So as restrictions were less and less and people were more mobile, we said, well, we don't have to go back to the office. So it helped us to look at our business model and what we were doing. And at the time, we were listening to biggerpockets.com. That's a really great investor for real estate podcast. And Brandon Turner had moved from Washington State, which is always rainy and cloudy, down to Maui. And on one of the podcasts, he was being interviewed, and he talked about his biggest fears. If he went down there, if he couldn't rent it out, or if he couldn't afford to live there, if business didn't work. And his co-host just said to him, it's like, what's the worst possible thing that could happen? It's a triplex. You rent out 2 of the other units. That'll pay for the mortgage. If it really doesn't work, you move back somewhere into one of your units, rent out the 3rd unit, and then it turns into a cash flowing property. Says, okay. So they moved to Maui. And at the same time, we love Aruba. You're in Aruba. I'm in Aruba. We love it, right? So we looked at our business, we looked at our assets, and it's the big what if, why not? Why not real estate? So we devised a plan to sell off a portion of our assets to move down here, where now we run Bel Air East, Bel Air West, Bel Air South, which leads us to the answer to the question. here we are on these podcasts. We're trying to share our experience, our education, our knowledge, what we've learned with other investors so they can follow us through the landmine field, not lose an arm or leg. You know, we did this, you can do this too. We did it this way, you could do that. And we're trying to, they say success leave trails of breadcrumbs. So we're trying to leave a path behind for a legacy so other people can do what we've done, so they can make those changes for their family. And now we never would have imagined this was possible, but through the relationships property management company, we have over 100 different landlords that we manage their assets for, over $90 million worth of assets. We manage these properties with an asset manager, and we've been approached by a dozen different landlords who want to invest with us. So now we're in a position where we have a raise of capital for about $1.5 million that we could put down on a property. So we could leverage that to buy a $5-6 million apartment complex. So that single family house duplex to 3-family to 4 to 6, you escalate and scale, you escalate and scale. Now, if we're going to buy 100, 150, 200, 300 unit complex, the pie is big enough for all of the investors to get a slice, a portion, where they can write a check, get a bigger check back. And as asset managers, 25 years of experience, now we can look at these deals, look at these properties and say, okay, we could buy this property in a value add proposition, see appreciation, go to a bank, refinance, and get our investors a bigger check. It's everything that we've been doing for the past 25 years. Now we're just adding 1, 2, 3 zeros to the process. So nothing has changed except the size of the property. I say all the time, properties are easy and people are hard. A property you can look at, figure it out, fix it, how you can increase the value of the property, raise the rents, decrease the expenses, and just force that appreciation in a value add situation. So why are we doing this? 3 years ago, we had our first grandchildren. So at that time, my wife and I, we were all set. We had our assets, we had our portfolio, we were done. We didn't have to do this game anymore, but we love it. We love real estate. We love the opportunity it provides, and we've learned so much about it. It's a game I want to play every day. So now I have grandchildren, and I want to build this legacy and teach them how to do this and take them by the hand as they grow up and say, this is what grandma and grandpa have done. And one of my sons, I have 2 sons, one of them works for us in the company, and he sees it. He sees it since he was 13 years old, just like me carrying plywood for my dad. He's had that experience, and I hope as he grows and develops as a real estate investor that he'll this legacy. What do we call it? Building generational wealth. That's our tagline at BHB Group, building generational wealth. So that's the future for us. And I think your sister, Marina, is actually working on a project right now in our market analysis. She's looking at a ton of publications, a ton of markets. There's several factors we're looking at right now. And we've got 3 or 4 markets we've targeted, but we really want to home that in. We've got the money, we've got the investors. We just need to get those relationships around and start looking at deals.
And can you please do a small summary for our listeners of what we have learned today?
Oh, wow. Gee, absolutely. I absolutely feel real estate is the #1 investment class out there. And of all the investment classes of real estate, I think large multifamily rental complexes by far has the best amount of return and reward for the investors. If you're an investor starting out today, keep educated, keep learning, keep reading, build a network of people smarter than you are who are doing what you're doing and learn from them. Change that group of people you hang out with to like-minded people, success-minded people, and just get started today. Just jump off the couch, get started, and make it happen. Make your dream your reality.
And how can our listeners can get in touch with you if they want to know more information or they have questions?
That's a great question. Thank you so much. You could do a Google search for Bel Air Property Management, and that will definitely get you to our property management website, which is belaire.co. It's BELAIRE.co, no M, just .co. And you can also go to bhbgroup.com, where you'll find out more about our investing opportunities, some of the different markets that we're in, a lot of our team, and so much more about our investing part of it. So we've got the side of it, and we've got the asset management side of it. Yeah.
Well,
That'll
thank
work.
you very much, Brian. And thank you to everyone. This is Maria Mendoza for the Why Real Estate Podcast and singing out.
Thank you so much.